Hello everyone, welcome back to another FinMeUp Weekly Stock Watch where we cover the most important stock market news, all summarized to the point with additional insights. I know we've been away for a while. The reason behind that is we've been really busy. The FinMeUp team has been busy building really exciting and valuable products. We've launched FinMeUp Pet Insurance. We've launched various other products and exciting features like our new website where you can also access what you see on the app on the website. So if you don't prefer using an app, you can now use and experience the entire FinMeUp experience on the website. Check the description for more information. Today we'll be touching on JSE, AB InBev, Spur, Glencore. So let's get into it. JSE. Net profit after tax increased by 10%. Headline earnings per share increased by 12%. And this is an interesting one. Non-trading revenue now represents 36% of operating revenue, which is up from 34% last year. But that is non-trading revenue. Now, that really is interesting for me because I've always thought of JSE as, it's just volume-based. The more people trade, the more revenue they make. But now seeing that 36% is non-trading revenue is really interesting. And finally, the group is now sitting on a robust balance sheet with cash of 1.9 billion rand. Paul, what do you make of these results?
Well, firstly, Hugo, welcome back. It's so good to be back. Super keen to get into this week in, week out again. And I know that the JSE, so I think many people will be surprised that the JSE is actually a company listed on the JSE. So remember, it's also a company with rules and regulations and investors and so on. Very interesting. They basically have a monopoly in South Africa. There are one or two other exchanges and obviously millions of brokers like Easy Equities that links to the JSE, but they are essentially the monopoly for stock trading in South Africa. And then how they make money, like you said, is people trade. So over the last decade or two, we've actually seen a decline in companies on the JSE, unfortunately. Either companies delist or they take their operations overseas. In other words, they list on an overseas exchange or they do the dual listing, where they have one leg in South Africa and one, for instance, in on the New York Stock Exchange or wherever. Looking at the results, not bad. Net profit after tax is up 10%. Headline earnings per share up 12%. I don't think the JSE is ever going to hit the lights out. So this is not a company that I will invest in as a company, but obviously we hope for the best. We want the JSE to thrive. We want investors, and especially international investors, to invest in South Africa so our stock market and our economy can really thrive.
Next company, something a bit different on the drink side, AB InBev. So their total revenue increased by 7.2% in the second quarter, but over the half year they increased revenues by 10%. But interesting, their total volumes declined by 1.4%. And there is an interesting reason behind that. Paul, care commenting on that?
Yes, I don't want to bring politics into our weekly wraps, Hugo, but they had a massive mishap with a marketing stunt that they pulled in the US. Unfortunately, the US is about 25% of their revenue income. So that's a big market. And if you tick some people off, you're going to lose some loyalty permanently. So unfortunately, that was a big mishap. I think someone got fired in that marketing team, if not the whole marketing team. And know your customer. That's basically what it comes down to. Without saying anything politically, know your customer. It did not work. But they're the largest beer brewer in the world, and the revenue is still up 7%. And I looked at the share prices. It's down quite a bit, I think, due to that mishap. So maybe there's an opportunity here to invest.
Interesting. There's always going to be a demand for their products. The next company is Spur. Earnings per share increased by between 78 and 83%. So obviously it was a trading statement. That's why they give a range. But up by 78% to 83%. That's a massive earnings per share increase. But it's also due to a company share repurchase that happened. So they bought around 1.5 million ordinary shares, which obviously reduces the weighted average number of shares. And that obviously helps the earnings per share to be higher, which means they have a lower PE ratio at the end of the day. So that's basically 101 on company repurchases. But the interesting insight, so obviously they have quite a few restaurants. Their restaurant sales growth percentages for their various big brands. They obviously have a lot of brands, but these are the biggest brands. So Spur increased by 24.9%. Panarottis increased by 18.6%. John Dory's increased by only 8.7%. RocoMamas, my personal favorite from these brands, increased by 9.6%. And then there's specialty brands, which includes the likes of Hasselgrill, Casabella, Nikos, etc. that increased by 42.2%. So that was the biggest growth aspect, was the specialty brands. The total South African revenue growth was 22.5%. Total international growth was 27.6% on a constant exchange rate basis. And total group, which is, Spur, total group revenue grew by 23%. 23%. Paul, what do you make of these results? Do you eat at Spur? We'd love to know your insights.
Brilliant results from Spur. What a success story. And the different franchises, Spur being the main growth company or main franchise, and then Panarottis. Yeah, it's great to see. I do actually, eat out at Spur every now and then. Maybe if I have a family one day, I will go to Spur on Sundays like I did when I was a child. Then just a quick recap. I think we have covered Spur in the past. How do they actually make money? So firstly, they don't actually own the Spurs. Okay? So that if you have a local Spur in Somerset West where you stay, it's not Spur's property, it's yours. You pay firstly for the brand. So instead of going Hugo's Grill in Somerset West, it will be Spur, owned by you. So you pay for the brand. Secondly, you pay the royalty income for the revenue. So a piece of everything you make, you pay over to the Spur. And lastly, of course, the actual meats and the sauces from the distribution center, you must also buy that from them. So that's how Spur actually makes money. And then we had this debate last time. We have two conflicting growth stories. The one is, yes, we're in recession. So remember, dining out is a product of or function of higher disposable income. The more money people have, the more they will likely eat out. But now, of course, we're in a recession, so that's down a bit. The flip side is we have load shedding. So making food at home isn't such a big thing as it used to be, even if people have less money, so they eat out. And with the family restaurants like Spur and Panarottis, it's not that expensive. So you can go and you can buy, a very nice pizza or a burger and chippies, and it's not that expensive. So, and then pair that with the share buybacks, which they did, which quite large buybacks, they did really, really well. So I'm stoked for the boys.
Yeah, well done, Spur. Next to the mining, Glencore. Revenue was down by 20%. A group adjusted EBITDA was also down by 50%. Net income for the period down 62%, and basic earnings per share of 36 US dollar cents, which is also down 61%. The commodities are taking shots. We've seen that with all the commodity shares. What do you think of this, of Glencore specifically, and of these results, or maybe the commodity sector overall?
Yes, that's a very good question. There's always a debate on where we are exactly in the commodity cycle, because it is very volatile. And being a miner, they're a product of, it doesn't matter what your volumes are. If the price of your product or your commodity declines, you're going to suffer some losses. And that's exactly what happens. So I don't think it's any fault of Glencore's. Maybe something interesting on Glencore. So by the way, that's being the main reason. The commodity prices are down, taking shots, like you said. So they are going to lose some money or make less profits. But they are not only a miner, they're also a trader. So for example, if you have energy company in India and they want some coal, they will call or WhatsApp Glencore and say, we need some coal. Glencore will then contact their contact in South America, and then they will buy the coal from them and send it over to India, and they will make some money there with the trading as well. So that's also a side of the business that's quite interesting to me. But once again, mainly the commodity prices are struggling a little bit, but I've heard some arguments that we might see another commodity cycle now. And there's a lot of online debate going on. Twitter is, the people are on their phones, and there's a very nice debate going on. So very interested to see where this is going.
Yeah, my pick of all the commodity shares are actually master drilling. It's not that cyclical. We've covered that, but anyway, just on the commodities, we all know it is cyclical. Then it goes up and then it goes down, and when it goes down or up, it's not just by 0.2%, it is by a lot. It's a very cyclical space to be operating in, and when you own miners, that's something you should know. As cycles can last longer than you anticipate, it can last shorter than you anticipate, but one thing is for certain, historically speaking, it is cyclical. Next, a company that is not too cyclical, but also, it could be cyclical, depending on interest rates and the economy, inflation, and so on, and that is Nedbank. Their revenue grew by 13%. Credit loss ratio was 121 basis points, which is up from 85 basis points. which was deemed to happen with the higher interest rates. Basic earnings per share grew by 8%. An interim dividend declared at R8.71, which is also up. So, good results from Nedbank. We've seen great results from various banks, like the likes of Standard Bank, which is my personal favorite banker at the moment, or bank at the moment. What do you think of these Nedbank results? And maybe just comment on the general space of the banks in South Africa. We've seen great results. Obviously higher interest rates, they make more money on the debt repayments that people pay. But with the credit loss going up, maybe bad debts going up, do you think they're going to have another successful year?
Yeah, that's a great question, Igona. We've debated this on the channel before. So banks make money with transactions and banking costs, but the main way they make money is, of course, interest rates, and they call it net interest income. So all the interest that the banks receive based on the loans that they give, minus all the interest that they pay on the deposits, just people with money in the bank. Now, if the interest rates go up, then they're going to make a lot more money. So that's the positive side. The flip side is if you have sustained interest rates and inflation and a recession like we've been experiencing, people are going to start defaulting on their loans. This is exactly what we saw. So if you look at for those of you who don't know, the credit loss ratio is what percentage of loans are bad debts, don't get repaid. So it was in the previous financial year 85 basis points, meaning 0.85%. Now it's 121 basis points, 1.21%. So that's up almost, 50%. So 50% more defaults, bad debts on the loans. Now remember, this was for the 22/2023 financial year. This was almost last year when you started seeing the interest rates hikes. Now we are in a very high interest rate environment. Yes, of course, it's basically flat now. I don't think the central bank will still increase it. But how will it look for the 2023/2024 financial year? In my opinion, we're going to see way more bad debts. So if you wanted to invest in a banker like Nedbank or Standard Bank, I think you should have invested a year ago and you would have done very well. But I think it's going to be quite a struggle in the next year because people are really struggling. Inflation is high, so they have less disposable income, and everyone has debt. And now people really cannot afford the debt anymore. So we see this in the FinTech community as well. People are struggling. So I think well done if you invested, great money to be made, but I won't invest in banks now.
Yeah, I 100% agree with you. It's going to be interesting to watch. The banks, we have amazing, phenomenal operators in the banking sector in South Africa. But also from my side, also not investing in the banks at this moment in time. That's all for this week's Weekly Stock Watch. We are back, so you can expect another Weekly Stock Watch next week. So make sure if you're not subscribed that you are subscribed so you don't miss. And if you found value, consider liking. Also, remember to check the links in the description. Go check our new website. Let us know what you think. I would love to get your feedback. And now you can also access what's on the app on the website. So it's the omni-channel experience like you'll learn in marketing. Thanks for watching. I hope you have a great day. Cheers.